Okay, welcome everybody. Applied Mortgage Academy. Your path to homeownership starts here. We do a few of these webinars a month, and you're in the right spot if you are looking for more information on buying a home. Maybe you're a first-time home buyer, maybe you're a repeat buyer. We're going to go over quite a lot today in ideally under, 25 minutes. Any questions you have, let me go back to that screen. Save my cell phone number or my email address, and you can reach out to myself or my team with any questions that you have, or you can pop them in the chat or the Q&A section today. I will send this recording out after so that you have it. We're going to run through how to best prepare to buy a home. Where do we think the rates are going to be going next? Will more homes sell this year? And what is happening with home prices? And I've been doing this for 19 years, managing the Applied Mortgage team for about the last 6 years. My dad owned our company before I did, and that started in 1987. So we've helped over 18,000 homeowners, mostly across Western Massachusetts, although we can help in all of New England. This is all kind of compiled data that we keep track of. We make sure we know what's going on in the market and how to best help all of you who are looking for houses and how to best navigate that market. So this market is not my mom's housing market. Somebody actually said that to me the other day when we were on the phone, and I thought it was so perfect. So I actually added it into this presentation. It's not like it was. If you go and you ask your friends or family or parents or grandparents or whomever that bought houses in the past, it's just a different process now. It's a different feel. It's a different market. It's really pretty competitive in most parts of at least where I am, mostly located in Hampshire County. We've got not a ton of inventory. We've got a lot of demand. That's shifted a little bit, but you want to make sure you're prepared. And it's also not like buying a car. I think most people, their biggest purchase that they've made oftentimes is maybe a car purchase, other than buying a house if you haven't bought before. When you go buy a car, you kind of show up, you pick the car you like, and then you figure out the finances. It's not really like that with a house. You want to first get pre-approved, talk to us, talk to a lender, make sure you understand your budget and what you're comfortable doing. That way you can go back to your real estate agent and say, hey, here's my parameters. Here's what I know I want in a house and the house itself. And here's what I know I need as far as my financials. And then you're already prepared to know exactly what that budget is going to look like, and you're prepared to actually make an offer and put your best foot forward. Most real estate agents and most sellers, they won't actually even show you the house until they know that you're already pre-approved. So this is really the first step. When you're thinking about planning to buy a house, again, whether it's your first house or you want to make a move to another house, really important, and we'll help you through this, look at your budget. Look at what's most important to you as far as the property, like I just said. Get pre-approved with a lender, meet with your real estate agent, and then you can go out there as a really prepared and educated and informed buyer. Our role, your mortgage team, my team here at Applied Mortgage, we are your mortgage advisors for life, meaning we're going to help you out through this purchase, next purchases, refinances, renovations, whatever else you have going on, right, when you own your home. So we're going to start off with a simple mortgage consultation where we review your goals and financials, really informal chat. Sometimes people are nervous to make that first contact. We're not just going to say, here's a stamp, you're approved or denied, right? Like, we're real people, you're real people. We're going to chat through what you've got going on. We're going to create a pre-approval, a plan that aligns your goals and your financials. And then while you're house searching, like we just said, because you're going to go back to your realtor and you're going to look for houses, we're going to provide you updates through our newsletter, our digital media, podcast, YouTube, if you want them, right, about what's going on in the market. Then you're going to get into the house. We're going to make that happen. We're going to work really close with your realtor and your attorney and your insurance agent and the appraiser and our underwriting team and everybody involved to get you into that house on time and exceeding your expectations. And then when you already own your home, we're here for support going forward. We provide annual mortgage reviews to make sure your payment's still comfortable, answer questions about anything having to do with that mortgage payment, taxes, insurance, whatever else. We can help point you in the right direction to other financial experts, maybe other contractors, right? Whatever else you need to make sure that your house financially and physically continues to meet your goals. And at some point, maybe it doesn't meet your goals anymore, and we talk again, right? And we figure out a new strategy. We go over goals, we go over financials, and we see what's up next. How are we going to go around this circle again? Are you going to buy another house, renovate, build, whatever else is going on? So the bottom line is that your pre-approval should really be the first thought. I know it's not the fun part. It's not like you're like, oh, I want to buy a house. Let me quickly go talk to my lender. What do? You quickly want to go online and you want to start looking at the pretty houses and decide what you want. I get it. But the financial piece is really important. You don't want to waste your time running around looking at houses and not actually know whether or not you can even afford to buy them. So a pre-approval, you really need that in order to submit an offer on a property. Sometimes you'll hear the word pre-qualification instead. That's kind of like an old school term. Remember, it's not your mom's mortgage or your mom's housing market anymore, right? That used to be the thing. You'd get like a really informal pre-qualification. You'd sit down with a lender and kind of back of the napkin, oh yeah, we think you can do it. Most sellers, that doesn't even really exist anymore because most sellers really won't accept it. You want to actually have a credit check done, your financials reviewed, automated underwriting, checkpoints completed. And now there's even so much as a fully underwritten pre-approval. That means we have our underwriting team review your information in advance. And if you haven't had a mortgage before and you don't know what underwriting means, it's basically like the audit that kind of happens when you're ready to get a mortgage. And I know that sounds kind of scary, but the whole reason to do this pre-approval is because we want to preemptively make sure that that mortgage underwriting review goes flawlessly and that you can get the mortgage that you want to get. So oftentimes, listing agents, when you go and make an offer on a house, you're working with your buyer's agent and you're going to make an offer on a house. The seller has their own listing agent oftentimes. The listing agents are going to review those offers. They usually call me. And if not, I offer to call them because it helps to strengthen your offer and it helps so that the listing agent knows that we're actually going to do what we say we're going to do and we're going to get you that loan and you're going to close on time. A lot of banks and lenders and loan officers, they don't have very good conversion rates from pre-approval to actually getting the loan approved. Industry-wide, it's only about 80%. We are about 96%, meaning the pre-approvals that we do are very solid. The reason is because we've got this awesome mortgage consultation process where we're going to go through all of your goals, most importantly, and then we're going to go through all your financials. And just the types of financials that you want to start kind of having in the back of your mind or maybe the front of your mind is going to be around three main buckets: income, assets, and credit. Those are really the three categories that most mortgage guidelines are going to look at to determine what you're qualified to do, what loan programs are out there. That's really heavily based on income, credit, and savings. Depending on your specific goals and your specific scenarios and your financials, we'll fine tune this list so that you know exactly what we need from you. Again, budget is really important. In that initial consultation phone call that we have, we're going to go through and help you. If you haven't already, we're going to ask you, what's your budget? What do you know your budget is? If you've looked at it, what do you want it to be? What are you comfortable carrying for a mortgage payment? And the number one suggestion I always have for people is really run your household like you'd run a business, right? You've got income coming in, you've got expenses going out. Write that all down. And we've got a really simple spreadsheet that we can help you make too. Now, after you put that budget together, you're going to know what are you comfortable paying for a housing expense. And this is just a totally sample made up housing expense calculation here. When you buy a house, your monthly payment is going to include the principal and interest, which is what you actually pay back on your mortgage. It's going to include real estate taxes that you pay to the town or the city. It's going to include your homeowner's insurance that you set up with an insurance agent. And if you're doing less than 20% down, you're probably going to pay some kind of mortgage insurance, private mortgage insurance. That's really foreclosure insurance. It's really just something that helps the lender, but you've got to pay it most of the time when you're doing less than 20% down. And then condo dues. If you're buying a condo or if you're in a neighborhood that has a neighborhood fee, you may have some type of association dues. So, principal, interest, taxes, insurance, maybe PMI, maybe condo fees. In this scenario, this was at 425 for the purchase price. This person chose to put 15% for the down payment. We're going to talk about the down payment and closing costs and everything in just a second here too. Their total monthly payment based on a 30-year fixed rate, and this is from earlier in the year, actually up in the upper sixes, rates have come down. We're going to go over that too. But that put them at about 3,100 a month with everything. And so this is what we'd review together. We'd do your own chart, make sure you're comfortable. Now, a big factor that determines interest rate, there's a few different factors, but one big piece of the puzzle are credit scores. So it's really important to focus on having good credit scores. Now, there are loan programs that go down into the 600s or maybe even the upper 500s for credit. And there are some loan programs that don't even penalize you for having scores there. But generally speaking, ideally, you want to be above 700 or even in the upper 700s. If you're not there yet, do not panic. We can still start the plan. We'd want to look at everything. We just do a soft credit check, so it doesn't even impact your scores when we check them. And we're going to be looking at a lot of things: your payment history, credit utilization, how long you've had your credit open, do you have new cards or new accounts, and what your credit mix is. So, like, do you have car loans, student loans, credit cards, mortgages? And this cheat sheet actually shows you what the credit scoring algorithm is made up of. So, payment history, paying things on time, super important. Keeping your credit card balances low, the amount owed, next important. So, like, if your credit limit's $1,000, don't charge it up to $1,000. Charge it up to maybe only $200 and then pay it off. Whether you've established new accounts, they actually don't like to see that you've been opening and closing accounts. They like to just see a nice lengthy credit history of the same accounts. And then credit mix. The algorithm likes to see that you've got open-ended accounts, which are credit cards, and close-ended accounts like car loans, student loans, that kind of thing. So we'll review all of that together. So we'll review your budget, we'll review your credit scores, we'll review, next up, cash to close. So on that last grid I showed, that person was putting 15% for their down payment. That's how much money they're actually putting toward the purchase price of the house. There's also, in addition to down payment, and by the way, that could be as little as nothing, potentially, if you qualify for the no money down programs. Usually it's somewhere between 3% and 20%. But in addition to that down payment, there's also closing costs. And you'll hear people just say closing costs as kind of a general term, but really there's like two categories. There's closing costs and then there's also prepaid expenses. They're all paid at the same time, so it's sort of confusing that they're called prepaids. But essentially your closing costs are going to be everything your lender does, everything your attorney does, appraisal, inspections, credit reports, and then also you're going to have about 6 months of real estate taxes and about a year of homeowners insurance. Now, something not on this slide is that your real estate agent is going to talk to you about their buyer's commission, their buyer agency compensation. And they're going to go over a special form, and that's part of their side of the puzzle. They're going to let you know, and you're going to decide with them how you want to negotiate in any buyer agency compensation. And so some people choose to pay their own realtor fees. If so, you're probably going to want another 3% or so of the purchase price set aside for that. Most of the time, what I see though, and again, I'm in Western Massachusetts and mostly Hampshire and Franklin County and Hampden counties, oftentimes we see that the seller is paying all of the real estate commission or most of it. And that's pretty much what it always has been. There's just some forms that you'll fill out so that you're really clear with your buyer's agent exactly what the expectations are. And if you own a home, you'll do the same thing with your listing agent. Just like on the pre-approval side, we're going to go over with you during your pre-approval all of our cost breakdowns as well. So what I usually suggest for a general rule of thumb is you're going to have whatever you have for your down payment, and then probably another 3% of the purchase price or so you're going to want for closing costs, taxes, insurance. Now, there's a lot of different ways to cover those funds. You can maybe have maybe you have your own savings, which is great, or maybe you can get a gift, or you can tap into retirement, or there's possibility of using a seller closing cost credit. There's also down payment assistance programs, right? There's a lot of different opportunities that are there that we'll talk through. So when you're deciding to buy a house, when you've decided, while you're house searching and while you're trying to buy the house, basically at any time during the planning or buying phase, keep doing all the right things that keep your income, credit, and savings on track. And don't change up anything that has to do with those three things, income, savings, or credit, until you talk. Sorry, I have a cold from my little kid, so gotta hopefully keep my voice for this whole seminar. So basically, keep paying everything on time. Tell your loan officer if there's any changes. Work your normal hours. Don't change jobs. Try not to make big deposits into or out of your bank account, right? All these things are really, really important to just stay on track and keep things consistent. All right, so let's get into some of the fun predictions now that you know how the mortgage process is going to work. So at the beginning of the year, um, a lot of the buzz around the presidential administration was that they were going to try to get rates to come back down into the fours. Now, most economists said, well, wait a minute, that's probably not going to happen. They're probably going to stay maybe around 6% or so as we go throughout the year. And what actually happened this year is mortgage rates went up above 7% for a while. But the really good news is that the Federal Reserve finally has said inflation is coming under control, more so where they want to see it. And we've slowly start to see mortgage rates come down. So that was one of the economic indicators that was really important for mortgage rate projections. We want to see that there is that inflation's coming under control. There's also a lot of volatility still in the market. So just remember, mortgage rates don't move in a single track, right? They're not just going to go up and then go down and stay on that trajectory. It's all up and down, up and down, up and down. And I'll show you that chart here in a second too. So here we are. And actually, we need to update this because things have come down even a bit more, which is really nice to see. This is just a trend of mortgage rates over the last year. Average 30-year fix. These aren't necessarily our rates or a specific quote or anything like that. This is just for information. So you can see how frequently the rates move up and down, up and down. There's no way to really time the market. So what I always suggest is when you do your pre-approval and you do your budget, you can't lock your rate in until you actually have a house under contract. So there's a little bit of guesswork, right? You're going to get pre-approved. We're going to go over a budget. We won't know 100% for sure if that's going to be your payment because you've got to actually find the house. And then you've got your house price locked in, your rate locked in. We know the taxes and insurance. We can pin down that budget. But you can kind of see here that rates at their highest in the last year went up to 7.25. At their lowest about a year ago, came down into the low sixes. And actually now, as we head into the fall, they're headed down into that low sixes range again. And hopefully they'll stay there. But again, there's no telling. We were hoping that last fall and they bumped right back up over 7. So the most important thing is to understand your budget. Now, you're going to hear a lot on the news, especially this week because the Federal Reserve is meeting tomorrow. You're going to hear a lot about the federal funds rate. I just want to make sure everyone knows that that is not mortgage rates. So if you hear on the news that the federal funds rate went up a little bit or went down a little bit, that's not going to directly impact mortgage rates. So like tomorrow, if they lower the rate by 0.25%, it doesn't necessarily mean mortgage rates are lowering by 0.25%. But it is good news. In general, if the Federal Reserve thinks that they're going to lower their rate, then probably mortgage rates have already reacted and started to come down like we've seen in the last couple of weeks. So just as an example, our average loan size around me is around $300,000. So you can kind of see on this cheat sheet here what that means for payment. So like at the highest when we saw rates were over 7, almost 7.5%, A $300,000 mortgage amount was a principal and interest payment of almost $2,100. And now, if rates go down to 6%, which they're seeming like maybe on track to do, then that's a $300 a month savings. So if you were looking for a house, at the beginning of this year when rates were up around 7.25, it's definitely worth it to try to look for a house again because the rate now, you might have a discount on your house, right? Compared to where you thought it was at the beginning of the year when you started looking. Now it might be $300 less. Now, again, we don't know where rates are going to go. They could pop back up, but it is a good time to get back in it this fall. So at the beginning of the year, also the predictions were going to be that more houses will have sold this year compared to last year. There's a little bit more inventory, which is nice. We're seeing houses on the market for a little bit longer. Number of house sales on the rise. That's all good because we want more inventory. It's been really tricky. And most economists were predicting, yes, that more houses would sell this year compared to last year. And the predictions for 2026 are already starting to come out too, and that's showing good signs. I think the mortgage rates coming down will alleviate some of the pressure so that more people are kind of more comfortable selling and moving, and that should create some really nice churning. Now, I get so many questions about housing crash, right? Well, are we going to have a housing crash again? What is happening? Values went up. Are we going to crash? So, and what happened before the 2008 housing crash is there was way too much inventory and not enough demand. So the economists measure something in the housing market called months supply of inventory. What that basically means is literally right now, if every single buyer bought every single house on the market, how much longer would the inventory last? And you want it to be about a 6-month supply. Before the housing crash, there was a 13-month supply, more than double of what it should have been. Right now, this year, we've been under 6%, or I'm sorry, under 6 months. We're at more like a 4 to 5 month supply. So we're just barely getting balanced. So don't worry about a housing crash right now because we're not even at that tipping point yet. It's evened out a little bit, but we're not quite there. And then appreciation this year, this was a forecast for appreciation this year, and it's been pretty much on track. Most economists predicted that we would again see more of a normalized appreciation around 3 to 5%. And that's a good thing. We don't want houses to keep appreciating, 10% year over year because that really is difficult for affordability for buyers. It's nice if you already own your house, but it's also tricky if you own a house because then your real estate taxes go up and your insurance go up, right? So we kind of want this steady trend. And again, economists were predicting that steady trend, which is great. And once you own, based on that steady trend, you're building equity. And that's the biggest thing about owning a house is you are building wealth. So if you bought a house for 450 in 5 years, you would have earned $90,000 in equity. So if you were to turn around and sell that house, you would have made $90,000 more. Again, this is based on national averages. And home prices nationally over the last 5 years, and I'm going to look at New England because that's where we are, have appreciated 65%. It's really, really a strong market. And it's not just in the last 5 years. Over the last 30 years, this is going back to 1991, we've seen 300% appreciation. So owning real estate, owning a home is a significant investment. Just in our area, in 2018, median house price was 280, and you can see how it grew 2019, 2020, 2021, right? We had this huge growth here. 2022 and then stabilized a little bit more. And these are averages, average median price. And again, owning a home, studies show make you 40 times, or sorry, improve your net worth by almost 40 times more than renting because of all of that appreciation and all that value. And you can leave that legacy to your kids, to your beneficiaries, right? You can tap into the equity for future things. Homeowners have more equity than they ever did before. So again, this is all indicative of a strong housing market and not a market that's going to have a bunch of foreclosures, right? Because people have a lot of value in their house and they don't owe much compared to the value. Back in 2008, 2009, you can see what happened. Equity went below. You hear people talking about being underwater. That means the value of the properties were less than the debt that was owed. We're not even near that now. Even if you go back here, right? Not even close. There's a lot of room. So I hope this presentation was really helpful today. A lot of people get their information from a lot of different sources. We are hoping to be one of those sources. Follow us on our Instagram, Facebook, social media, all the things, and we'll keep you updated on what's going on in the market and some mortgage tips and tricks. Only 51% of the next generation of homeowners feel like they're confident in their financial literacy. So we strive to be educational resource for people, and we want to reverse that trend. We want to improve this number. Anything that anybody needs, thank you so much for attending today. I know it's a lot of information, and that's exactly what we're here for, is to answer any questions that you have. Scanning this QR code gets you to our scheduling tool where you can set up a complimentary consultation with myself or somebody on my team anytime that you're ready to chat. No question is too big or too small. We answer them all the time. And whether you're thinking of buying a house tomorrow or in 10 years from now, it's never too early to have that conversation and to start planning. Thanks again for tuning in. We will get this recording out to you shortly and look forward to helping you with your homeownership goals in the future. Have a great afternoon.